This is unbelievable. The SCHD New Dividend update just dropped. This changes everything. Before we dive in, if advertisements should interrupt this video, please do not click off of the advertisements. Please allow them to play through as a thank you to me for bringing you this honest, valuable information for free. Now let's continue. Hey everyone, and welcome back to the channel. There's a buzzing conversation happening right now in the dividend investing world. And if you're someone who relies on passive income or is actively building a robust dividend portfolio, you need to hear this. The Schwab U.S. Dividend Equity ETF, or SCHD as it's universally known, just released its latest dividend update. Now, for many, SCHD isn't just another ticker. It's a cornerstone, a bedrock in their long-term wealth-building strategy. When a foundational asset like this makes a significant move, it's not just a minor adjustment. For many of us seeking sustainable dividend income, this changes everything. We're talking about the potential ripple effects on your income stream, your portfolio rebalancing decisions, and ultimately, your financial peace of mind. Today, we're not just looking at a number. We're breaking down exactly what this new dividend announcement means for you, how it impacts your dividend growth investing strategy, and the actionable steps you can consider right now to optimize your approach for long-term passive income. This isn't about panic. It's about informed decision-making to secure your financial future. To truly master this, or to succeed at this, we first need to understand the fundamental role SCHD plays in so many portfolios. SCHD isn't just an ETF that pays dividends. It's specifically designed to track an index of high-quality U.S. companies that have a consistent track record of paying dividends and are financially sound. Think of it as a carefully curated basket of dividend champions. It screens for factors like cash flow to debt, return on equity, and dividend growth rate, aiming to give investors exposure to companies that not only pay you, but have the financial strength to continue growing those payments year after year. This focus on quality and growth, rather than just raw yield, is precisely why so many long-term investors, from individual retirement accounts to taxable brokerage accounts across the United States, Canada, the UK, and Australia, have made it a core holding for reliable quarterly dividend payments. It's about more than just getting a check. It's about getting a growing check from financially stable businesses. So, when the latest SCHD dividend update hits, it's not just an academic exercise. For someone planning their retirement income or a younger investor diligently reinvesting their dividends, this information is incredibly pertinent. Historically, SCHD has been lauded for its consistent dividend growth. That's been its major selling point. Investors have come to expect a certain trajectory. But markets are dynamic, and company performances shift. This recent announcement reflects those changes. What we're seeing isn't necessarily a failure, but rather a recalibration in line with the underlying performance of the companies within the fund. Understanding the why behind this adjustment is crucial. Is it sector-specific weakness? A broader economic trend affecting dividend payers? Or simply a shift in the companies that meet SCHD's stringent criteria? These are the questions we'll unpack, because your ability to adapt your own dividend income portfolio hinges on understanding these nuances. This is about learning to navigate the real world of dividend investing for beginners and seasoned pros alike. Now let's get into the heart of the matter. What does this recent dividend update actually entail? Without revealing specific numbers that could quickly become outdated, what we're observing is a departure from the historical growth rates many have come to expect. This isn't to say dividends are disappearing, but rather the rate of increase has potentially moderated, or in some cases, seen a slight adjustment downwards compared to previous periods. For someone who has meticulously calculated their expected passive income from dividends, this could necessitate a review of those projections. It's a moment to pause and assess if your financial independence strategy still aligns with the updated reality. For example, if you were banking on a specific percentage increase year over year from your SCHD holdings to cover a certain portion of your living expenses, this new data point requires a fresh look. This is where transformation-based learning comes in. It's about moving from simply knowing a number to understanding its implications for your personal financial goals. It's about empowering you to make adjustments that strengthen your position. What truly changes for the individual investor, then? Firstly, it's an important reminder that no investment delivers guaranteed returns or growth. Even the most robust ETFs, like SCHD, are subject to market conditions and the performance of their underlying holdings. For those focused on building wealth with dividend stocks, this update emphasizes the importance of diversification. Relying too heavily on any single ETF, even a high-quality one, can expose you to concentrated risk. This isn't a criticism of SCHD, but rather a practical lesson in portfolio construction. Secondly, it could prompt a reevaluation of your dividend reinvestment plan, DRIP. If the growth rate is slowing, the power of compounding might not be as aggressive as previously projected. This isn't a reason to abandon DRIPs, but to consider if a portion of your dividends could be redirected to other opportunities presenting stronger growth prospects or higher immediate yield, depending on your stage of life and financial objectives. This is a critical point for anyone focused on retirement planning with dividend income. So, what are the actionable steps you can take in light of this new information to ensure your dividend growth portfolio remains resilient and continues to serve your financial goals? The first step is always to review your own portfolio and understand your current allocation. How much of your overall passive income stream comes from SCHD? If it's a very large percentage, this might be a signal to explore adding other high-quality dividend-paying ETFs or individual stocks that offer diversification in terms of sectors, geography, or dividend growth profiles. Consider researching other dividend ETFs for passive income, perhaps those focusing on international dividends or specific sectors that show strong growth trends. Remember, the goal is often to create multiple income streams, not just one. The second actionable step is to reassess your personal income needs and timelines. If you're very close to retirement and relying heavily on current income, a slight moderation in SCHD's growth might mean you need to adjust your spending expectations slightly, or perhaps look at supplemental income sources. If you're a younger investor with decades until retirement, this might be a fantastic opportunity to buy more SCHD at a potentially lower valuation if the market overreacts, effectively locking in future dividends at a better price point. It's about leveraging these moments, not just reacting to them. This strategic buying, especially during market fluctuations, is a hallmark of successful long-term wealth creation. Furthermore, consider looking beyond just the headline yield. While yield is important, dividend growth rate is often more critical for long-term investors aiming for inflation-beating income. This recent update provides an excellent opportunity to compare SCHD's updated growth projections against other dividend-focused funds. Are there other ETFs that have maintained or even accelerated their dividend growth? Examining the underlying holdings of these alternatives can give you valuable insights. Perhaps a focus on high-quality dividend stocks with strong free cash flow is even more crucial now. This analytical approach moves you from a passive investor to an engaged, empowered one, actively shaping your financial destiny. This kind of research is invaluable for anyone building a robust income-generating portfolio. Another practical consideration is the role of sector diversification within your dividend holdings. SCHD, while diversified across many U.S. companies, does have its own sector weightings. If the recent dividend adjustment is partly due to headwinds in sectors heavily represented in SCHD, then exploring dividend ETFs or individual stocks with exposure to different, thriving sectors could be a smart move. For example, if financials or industrials are seeing a slowdown, perhaps looking into high-quality healthcare or technology companies that also pay growing dividends could balance things out. This proactive management of your investment portfolio for dividends is what separates those who simply invest from those who truly thrive. Ultimately, this SCHD dividend update should not be seen as a cause for alarm, but rather as an invaluable learning opportunity and a catalyst for strategic reflection. It reinforces the core principles of intelligent investing, diversification, understanding the underlying fundamentals of your holdings, and regularly reviewing your portfolio against your evolving financial goals. For those building a sustainable retirement income strategy, these moments are crucial for fine-tuning your approach and ensuring you remain on track. This is about taking control, not just letting things happen to you. It's about developing the knowledge and confidence to make informed decisions that serve your journey towards financial independence. So, what are the biggest takeaways from today's discussion? Firstly, stay informed. Dividend updates, especially from core holdings like SCHD, are critical data points. Secondly, use this information to review your own portfolio's diversification and ensure you're not over-reliant on any single asset for your passive income. Thirdly, always align your investment decisions with your personal financial goals and timeline. And finally, remember that consistent learning and adaptation are key to successful long-term investing, especially when it comes to generating consistent income from investments. If this deep dive into SCHD's latest dividend update was helpful for your passive income strategy, please consider subscribing to the channel for more objective financial insights. Leave a comment below letting me know your thoughts on this update and how it impacts your dividend investing journey. And don't forget to hit that like button to help more people discover this valuable information. Disclaimer: I am not a financial advisor. This content is for informational and educational purposes only and should not be considered financial advice. Investing involves risk, including the potential loss of principal. Please consult with a qualified financial professional before making any investment decisions.